From 2011 through 2014, with oil over $100 a barrel, we experienced a period of supernormal abundant liquidity. Clearly over the last 18 months with oil now, south of $40 a barrel, there's been an undeniable change in the liquidity and regional landscape. That, however, has manifested itself in a number of different ways, and the implications are certainly not linear. They would be what I would describe as asymmetrical. So different geographies, different issuer constituents, and the bond and the loan markets have reacted in different ways. Certainly we've seen upward pressure on pricing. So pricing is higher today than it was 9-12 months ago. However, that pricing has affected different markets differently. In the capital markets, the bond market, we've seen an assessment of international relative value and geopolitical risk premia weigh most heavily. Interestingly, the percentage allocation of bond issues from the GCC over the course of the past 9 months is higher into regional investors than it was when oil was at a higher price point. The reason for that is that the assessment of relative value from amongst indigenous investors is quite different from that of international accounts. The JP Morgan EMBI has moved up by a greater amount across the broad complex than we've seen within the GCC constituent, which is somewhat counterintuitive given that the GCC is most exposed to the oil price. So what we have right now is a phenomenon whereby regional investors are willing to demonstrate or put to work liquidity and support transactions at a price point that many international accounts consider too expensive. On the loan side, interestingly, it's been the international lenders who've been supporting lower pricing, particularly at the top of the market with the GREs. The GREs command pricing that's inside the funding costs of many of the regional banks. So there's been a domination of lending in that sector from international providers. When one moves down into the more medium-sized companies who are more dependent for the provision of financing, the provision of liquidity from regional providers, we've seen the increase in their funding costs be that much more, given that the regional banks that are providing that liquidity, their own funding cost has become significantly elevated. The biggest single development that I can think of over the course of the past 12 months in terms of buy-side dynamics for GCC bond and Sukuk is the emergence of private placement demand. In the first quarter of 2016 at NBAD, we placed $900 million of GCC issuance into what I would describe as non-traditional investor types, primarily in Asia and to a lesser extent in the GCC. That's more than we did in all of 2015. These are bullet maturities. We're looking at, we've executed callable structures. To a very large extent, this has been motivated by the low volumes that we've seen in the public markets, but there certainly seems to be increased receptivity amongst investors in the two geographies that I mentioned to buy GCC product, and I think that's very encouraging for the long-term development of the financing markets in this part of the world. We've seen heavy local currency issuance from the government of Saudi Arabia, from the kingdom, from the government of Qatar also. Beyond those two sovereigns, regional issuance tends to be predominated in US dollars. Many of the currencies here, of course, are pegged to the US dollar, which goes some way to explaining that. The US dollar capital markets, of course, are the deepest pool of liquidity globally. We have a number of mandates currently in euros, so that's something that we haven't seen very much of during my time in the region. And certainly from our perspective, there is a keen initiative to promote the development of a coherent dirham capital market in particular. And I'm optimistic that we'll see that come to fruition over the course of the next several months.